Good morning. Today is June 19th. This recording is being done at 10:30 hours from the house of Akshaya or www.akshayaship.com or Lotus Advisory Services. My name is Shiv Kumar and I'll give you a wrap-up of the commodities complex as it's been panning out for the past few trading sessions and the trends for the coming day and weeks. First, I'll give a macro level view of the economy as a whole, both from the US economy and from the Indian economy point of view. The FOMC meet concluded yesterday in the US, and the markets, as they had anticipated, the decisions came out. The QE3 or the stimulus was reduced by $10 billion, interest rates left unchanged, and the commentary said that the economy needs to improve before steps were taken for reduction of any further interest rates. The markets buoyed and the US equity markets, the Dow Jones hit record highs late last night. As far as the Indian markets go, two important factors that seem to impact the markets are the trading in the INR. INR, after hitting a high of 58.5 over the past few weeks of trading sessions, yesterday broke the 60 barrier and closed remarkably weaker at 60.39. However, during the course of early trades today, it's still hovering around the pivot of 60. It's strengthened by around 40 paise today. Equities are facing stiff resistance at every higher level. The Nifty, after hitting a high of 7,700, broke down to around the 7,550 levels. What is happening is lower highs are being formed over the few trading sessions. After hitting initial highs of 7,700, yesterday's high was 7,650. Today's high seems to be around the 7,600 mark. 7,500 to 7,450 are strong levels which we need to watch out for. If sustained below 7,500, could further weaken up to a level of 7,300 at least. Watch out for movement in the Nifty could affect the INR movement. Any weakness in the INR could send the INR further weakening to around the 60.5 to 61 rupee mark, holding commodities higher. So every day we need to monitor the movements of the INR to track the MCX opening rates. Although in dollar-denominated commodities, the trend may be quite the contrary. Now, another major impact of the economy as a whole for India would be the impending budget and the monsoon worries that are hitting the markets. The markets are expected to be below normal. This could send inflation higher, and the government may scurry for cover and take necessary steps to rein in the inflation, which have a negative impact on the INR also, and especially on the NCDX agri commodities, which could shape up a little bit higher if the monsoon were to turn out weak. Now we'll talk about the individual commodities. First we talk about gold. Gold over the last 10-15 days, after hitting consistently a couple of times lows of around the 1240 to 1250, seems to be bouncing back from those lows. Hit a high of 1285 a couple of days back and now consolidating around the 1275 to 1277 mark. Resistance is now at 1290. Next upside could be seen on a break and close about 1290 up to 1300. A break about 1300 only will clip a decisive breakout to around the 1320 to 1330 mark. On the downside, 1260 is an immediate support, and below that 1240. Any break below 1240 only could decide the next lower levels for gold. So long as 1240 holds out, you can see that it is going to remain in a range of 1240 to 1290 for now. On the MCX, trades at around the 26,800 mark. Immediate support is seen at 26,700 to 26,650, and resistance is around the 27,000 to 27,100. Although in dollar terms, the gold may be oscillating up and down, keep a watch on the INR, as weakness or strengthening of INR could impact the MCX prices dramatically. It is suggested that as far as gold is concerned, you do only intraday trades, as the market scenario changes on a day-to-day basis, both on the above factors of dollar terms and in the movement in the INR. Silver is now trading at around the 19.80 mark, consolidating and not breaking below the 19.3 to 19.4 and not breaking above the $20 mark. On the MCX, trades around the 42,500 mark currently. Strong support is seen on a weekly basis at 41,800 and resistance at 42,800 to 43,000. Any break on either side could decide the next move. So the trading range can be safely said as 41,800 to 43,000. Both for gold and silver, it is advised to trade with caution, wait for dips to buy probably, and wait for those corrections for the market to rally higher, and keep booking at every high set, and not suggested to carry over trades, especially on a positional basis. Crude is now trading at around the $106.5 mark. It is, although the geopolitical tensions in Iraq is holding crude higher, it is unable to break and sustain above the $107 to $107.5 mark. Support is now seen at 105. On the MCX, the trading range is seen of a low of 63.60 and a resistance of 64.50. Overall buy on dips is suggested with a stop loss of 63.60 or even 63.40, and 64 if it holds above 6400, 64.50 and above that 6500 and 65.20 could also be targeted in the days to come. So long as the Iraq crisis continues, crude oil is expected to continue to be on the boil, and buy on dips would be the best strategy for intraday trades. Natural gas is now trading at around the 278 mark, expected to take strong support at 275 and 272, and resistances at 282 to 285. With the inventory coming today, it is better to wait for levels of the inventory before you take any further positions in natural gas. Base metals are trading extremely choppy over the past few trading sessions. Copper testing the highs of 410 and bouncing down clearly on a day-to-day basis for the past few days. Now trading at around the 404.5 mark. Expected to take support at around the 400 to 401 levels and bounce back to test the resistances of 407 and 409 and 410. Only a close above 410 to 411 could give the next breakout up to 450, whereas a close below 400 could test previous lows of 398 and 396. Not much opportunities are coming up in copper over the past few trading sessions. You can at best make up about 3 to 4 rupees on an intraday basis. Best to do intraday trades and avoid carryover trades. Nickel is seeing sharp upside and downside and having a zigzag pattern. In fact, today it opened at lower circuit at 1071, now consolidating at around the 1100 mark. So long as it holds around above the 1100, could test up to 1110 to 1120 with current support at 1090. Zinc and lead both are trading in a zigzag manner. Over the past couple of years, if you have seen that lead was holding at a premium above zinc, but now it is a reverse, and zinc is holding a premium of 2 rupees over lead. Zinc is now trading at around the 127 mark and lead around the 125 mark. Zinc is fundamentally more stronger than lead, and hence on a positional basis better to start accumulating zinc on every dips. Lead is giving an opportunity of only about a rupee on a day-to-day basis, both on the buy or on the sell side. The most optimistic views coming up on aluminium as far as fundamental data go. It is expected to hit in the coming sessions $2,100 on the LME, and any dips on the MCX can be used to accumulate up to around 109 to 108.5 with stop loss below 106. A break and close above 111.20 could be more positive, and in the coming few trading sessions, maybe even on a long-term basis, positional basis, it could touch even 115 to 120 levels. So among all the base metals, aluminium seems to be the most optimistic, whereas the others are expected to be range bound, with zinc coming in second in terms of buy trends or signals that are coming both on a fundamental and on a technical basis. Here I have given a brief wrap-up of all the commodities as I see it on an intraday basis. The trends are likely to change as and when the data keep coming up from the US on a daily basis. I would request the viewers and members to keep booking profits on each commodity at every profits that you see, and not carry over positions on a positional basis till the trend becomes clear. For further updates and commentaries, please visit our website at www.akshayaship.com or on our Facebook for the Lotus Advisory Services with the double S. Have a safe and profitable trading day. Thank you.